Hello and welcome to Fintech Insider Insights. I'm Kate Moody, Customer Strategy Director at 11FS. In this episode, we'll be exploring the tough funding landscape for small and medium-sized businesses in the UK and beyond right now, and the downturn in funding from big banks despite increasing demand. But it's not all doom and gloom. The big banks' hesitancy is creating an ideal opportunity space for fintechs, neobanks and alternative lenders to play in and become market leaders, further disrupting the banks and furthering their growth journeys. I'm really excited today to be joined by a fantastic panel of guests who know a thing or two about this space to dig deeper into this. So first up, we have long-term contributor and friend of the show returning for an amazing 27th time. It's Valentina, Kristensen, Corporate Affairs Director at OakNorth. How are you doing, Val? Thanks as always for joining us. Can you remind our listeners, I doubt they'll need a reminder, but what does OakNorth do and why are you particularly relevant to today's conversation?
Yeah, hi. So thanks so much for having me back on the show. It's great to be back. For those who aren't familiar, OakNorth is a challenger commercial bank. We launched in 2015 with a full banking license. And to date, we've lent almost £11 billion to businesses across the UK. And as of the latter part of last year, across the US as well. And we've also, again, as of last year, started exploring additional products and services for our customers, our business customers. So current accounts, savings accounts, credit cards, FX payments for businesses. So yes, very excited to be discussing the SME finance landscape today.
Awesome. Well, yeah, thanks as ever for joining us and looking forward to picking your brains. Joining Val, we have a Fintech Insider debut for Christoph Rieche, CEO and co-founder of iwoca. Welcome to the show, Christoph. iwoca's had a pretty incredible couple of months. And for those who have been under a rock and missed it, what have you been up to and kind of what does iwoca focus on more broadly?
Thank you very much for having me on the show. So for those who don't know us, we're lending to small businesses over the more than 10 years that we've been operating now. We have funded a lot more than 50,000. So that's a lot of small businesses that have received funding from us. And we're coming closer to our mission to finance 1 million. Still quite a bit to go, but on track. We've raised quite a bit of funding in these last few months, 270 million, bringing our total funding raise to more than $1 billion. So it's been a really great first half of the year for us.
Yeah, busy. Well, thank you so much for taking the time to come speak to us. And likewise, looking forward to picking your brain as well as we go through. And last but definitely not least, completing our lineup, we have Brian Baldacchino, Head of Lending Strategy and Corporate Development at Allica Bank. Again, welcome to the show, Brian. Thanks very much for joining us. Allica Bank has also been pretty busy. You guys have just been named the fastest growing private company in the UK by The Times. But again, we have a wide variety of listeners who might have different degrees of knowledge about the fintech space. So would you mind giving people a reminder about who you guys are, what you're doing, and I suppose your role in particular, please?
Thanks, Kate. Really great to be recognised by The Times alongside so many brilliant British businesses. It's been quite a journey, and also really great to be here for the first time today. So for those who don't know Allica is a UK challenger bank. We launched in 2019 and became profitable 3 years later. We've lent over £2 billion to businesses so far. We were built especially for what we call established SME businesses. Just to explain that, these businesses, there's 500,000 or so in the UK, and typically they have between 5 and 250 employees, and they make up about a third of UK employment and turnover, so really systemically important to the UK economy, as well as local communities nationwide. I think sort of very pertinent to the topic of conversation today. I think we see that the service they get from the big banks is increasingly impersonal, inconvenient, poor value, and we don't think that's right. So we're on a mission to bring back business banking how it used to be, just better. And by that, I mean providing deposit accounts with no monthly fees, relationship managers whose names customers actually know, and technology that makes people's lives easier, not harder. And we're a technology company as much as we are a bank. We build our own proprietary technology. Allica, I wear two hats, so a fairly lengthy job title, but there's two hats. So on the lending side, I work a lot on our portfolio management and credit strategy, working a lot of our product teams to deliver lending solutions for our customers and work a lot with data and analytics. And then on the other sides, I lead the inorganic side of our business. I think our M&A, our lending partnerships and investors. And I think one of the interesting parts for me is that I've got to work with so many brilliant fintechs and alternative lenders in the market who are an increasingly very important part of the funding landscape for SMEs. So yeah, great to be here.
Brilliant. Well, yeah, thanks also for joining us, and yeah, looking forward to getting your perspective as well. So yeah, with that, let's jump in. Tons to cover. So I suppose in the first part of the show, we're going to discuss the current state of financing for these SMEs or SMBs, as they're sometimes referred to in other parts of the world, and the options that they have available if the high street banks are backing off. So again, I suppose as most of you have alluded to in your intros, I think we're all pretty agreed here that SMEs are the lifeblood of pretty much all economies globally. Obviously different stats, but they're hugely important across the world, and cash flow is the lifeblood of those SMEs, and often they need access to finance and capital to kind of keep them going, particularly when cash flows are tight. I suppose, Val, maybe to start us off, how do SMEs typically get access to finance? What are the avenues that are open to them?
Sure. So I mean, look, I think and Brian's kind of alluded to this point a little bit already. SME is a very broad term. And I kind of hate it, actually, because I think, you kind of encapture everything from a startup, one-man or one-woman band, through to, a business with hundreds of employees and potentially, hundreds of millions in turnover. And those businesses will obviously really have very different needs and different degrees of sophistication in terms of what funding requirements they might have, and very different teams, right? Some might have an accountant they speak to once a quarter. Some might have a finance director. Some might have a CFO and an entire team. So, I think the point is that you can't kind of lump them all into one box. Similarly to Allica, I mean, OakNorth targets a specific niche of SME. So we sort of say businesses with $1 million to $100 million turnover. We did some research last year with the Social Market Foundation, which showed that those businesses account for less than 1% of all SMEs in the UK, but account for 22% of SME turnover. So that just kind of gives you an idea of that sort of outsized impact. And in terms of the finance, I mean, I think available to them, it totally depends on where you are in that scale, right? If you're a business that's making, 50K ARR, then you're probably not going to be able to apply for a loan of millions of pounds, right? In which case you shouldn't come to an OakNorth or indeed an Allica. But perhaps you could go to, a platform like an iwoca or a Funding Circle, or indeed one of the smaller, or one of the neobanks that focuses on smaller businesses. So like a Starling, a Revolut, Monzo, Tide. I'm not talking about those with or without licenses. I'm just saying those who have offerings that can target smaller businesses. Then, of course, you do have other types of funding, right? Not just the type of asset-backed or cash flow lending that an OakNorth might provide. There's lots of different things. I mean, even our customers, one of our customers, Daisy Green Collection, they're a restaurant chain here in London. They did crowdfunding before they came to us, and they did crowdfunding very successfully. Not necessarily because they needed the cash, but actually it was more to create a following, to create those brand ambassadors. Peer-to-peer lending was bigger back in the day. I would say it's become less so in the UK today. I was at an event yesterday, which was around angel investing, and particularly angel investing in female-founded businesses. There's an amazing angel network in the UK, a growing angel network. Venture capital, private equity could be an option if you're happy to dilute. I think, the debt option is obviously, once you've got more of a proven business model, equity is very expensive. So you almost want to go down the debt option. So there's really a very broad range, but it depends on where you are in that SME scale and how big a business you are and what your funding requirements are.
Absolutely. And I think that's a really comprehensive overview. Thank you. Christoph, obviously you've been a founder yourself. I'm sure you've kind of gone through various degrees of this process. What are the challenges to getting funding as an SME, I suppose, if we're going to take it back to first principles?
Yeah, it is a really bruising process that I have been through many, many times. You need funding. You need to find a source of funding. You don't quite know what to expect. That's the reality that a lot of people find. And if you take a small business that has started maybe a year or 2 years ago, they don't have a long track record, and the business still might be very volatile. If they approach their bank, they just flat out fall out of the eligibility criteria. And so for many businesses, they historically just didn't know where to go because the main providers weren't really able to support them. And it's really great to see that now I think 60% of all SME lending is done outside of the big banks. And that really means that lots of businesses like us, Allica or OakNorth for the more established ones, have put up shop and deliver a very tailored product to everyone's needs in the market. And I think that's been the biggest change that I've seen over the last 10 years. It simply didn't exist back then, and I'm proud that we could contribute to that.
Yeah, no, absolutely. I think, I suppose we're focusing a little bit on the problems at the beginning, but I think it's definitely worth acknowledging even where we are now with all the problems that exist is still progress from, I think, where we were or have been in the past. Brian, when your customers at Allica are looking for funding, what typically are they struggling with most? What are the questions they have?
So I think in order to answer it, I think you always have to look at where business banking has come from and where it is now. So 20 years ago, if you were a business owner and you wanted to take out a commercial mortgage to purchase the premises that you're trading out of, you would go to your bank branch, you'd see your local relationship manager who would know your business. Now, I think the demise of the branch network for the big banks and the sort of the withdrawal of the branches has actually also led indirectly to the withdrawal of relationship managers who understand businesses. And as a result, the banks are forced more into a cookie cutter approach, and either the businesses fit that or not. And I think we all know we work with SME businesses. They're complicated. They have circumstances, they have aspirations and complications, and they need people who are willing to listen to them and understand their business. So I think the availability of credit has directly declined with the availability of that relationship management model, would be my take. And obviously that's created a gap. That's created a gap for alternative lenders, alternative challenger banks like Allica, OakNorth and others in the segment to fill that demand which is there, because fundamentally SME business owners need access to finance to pursue their growth ambitions.
Yeah, I mean, Christoph, you guys have recently, iwoca published some research saying that sort of 4 in 5 brokers, 84%, are saying that the high street banks that they're working with, liaising with, are reducing their appetite for funding SMEs. And does what Brian's saying make sense within that context? Were there other things that you guys found within the research that are driving that?
Yeah, I think the trend is certainly, as I said, 60% of SME lending is coming from providers outside the big banks. That's sort of another way of looking at it. With brokers saying that banks are retreating. I think, all of us have invested very heavily in delivering a fantastic experiences to our businesses to break down the barriers that I was alluding to, that you sort of need funding and you just don't know how to access it because it feels banks have been throwing so many hurdles in your way in the documents they were asking for, the back and forth process, making the whole process, taking weeks or even months to even get to a decision. We as an industry have innovated very much, streamlined processes, and in our case, we can deliver decisions in microseconds from receiving some relevant information about the business, often complemented through many API integrations that we have to get the necessary data to be able to make the decision. It's just day and night what happens over those last sort of 10, 15 years in the proposition being offered to businesses. And so I think you have the risk appetite not increasing from banks, but decreasing over time, focusing on other asset classes they feel more familiar with. And then on the other hand, businesses like ours are really pushing very hard on the innovation front and offering a better experience, which means that we just as an industry start to have the upper hand.
Yeah, I suppose I'm keen to, obviously we started, I suppose, talking primarily about the UK because that's where all of you guys are headquartered, but yourself, Christoph, Val, as you mentioned in your intro, you're also operating in other markets. So Val, are the problems that we've talked about UK specific, or have you seen similar issues as you've started to move into the US market?
I mean, they're definitely similar issues. I mean, in the same way that you said in the beginning, SMEs broadly make up the backbone of economies globally. I think they have, the move towards, again, kind of thinking about what Brian said, if you look at what's happened in the market, as we've moved towards digitization, banks have invested in their SME, in quotation marks, offerings, but much more at the smaller end. it's sort of retail plus. So where they can potentially provide a loan quickly using a sort of credit score automation type of model, where they can service a customer well through something like an app, and they don't really need to interact with them in person. But once a business reaches that scale where they perhaps have a more complex ownership structure, they have perhaps more complex financing needs, that's where there's been a sort of chronic underinvestment. And to Brian's point, as you've kind of moved towards a more centralized decision-making away from this regionalized relationship managers and local branch managers, you've ended up with this situation where there is this gap. And that in the US, for example, has been exacerbated by the recent, or I should say recent, in the last 14 months, the collapse of several banks like Signature, like Silicon Valley Bank, which typically were servicing that high growth entrepreneurial business.
And I'd just like to jump in there because I think that this is something that we look at, and it's true in the UK, it's true in other markets around. There's actually structural reasons why the big banks find it hard to service this segment. And when I say this segment, I'm referring to this sort of established SME middle. I'll sort of unpack that a little bit. But for this segment, the complexity of serving them is greater now than the value that it creates. And if you sort of think about the two main profit centers of your big universal banks, on sort of one end you've got the low volume, high value corporate customers, the 10,000 or so Vodafones, etc., who are extremely high value, and that the solution is solving that with an intensive coverage model, i.e. you've got lots of relationship managers understanding everything about the business. It's highly manual, but that works because of the value per customer. And then right at the other end, you've got your 30, in the UK at least, you've got your 30 million or so homogenous households who are very simple. And so much investment has actually focused on automation in that sector, sort of really great digital experiences. And the big banks have come a long way in that. And actually, by extension, micro businesses can be served on those retail platforms. This is Christoph alluded to. So, and just then to make the distinction around the established SMEs who sit really awkwardly in the middle of these business models of the big banks, in the sense that they are complex in many ways like corporates, but you can't automate them fully like consumers because they have elements of complexity. And Val alluded to the sort of the different legal entity structures, multiple UBOs and directors, different agents and third parties involved, your accountants, your lawyers, etc. Their demand for credit is actually much greater. And this is why I think we are seeing the withdrawal of the relationship management model, because that model no longer works. And that's, for us, the really key channel that we're looking to drive, because that's ultimately how business owners like to access their capital. It's emotive. Taking out these big loans that are quite existential for the companies, they like to speak to someone.
Yeah, no, absolutely. I couldn't have agreed more with what you were saying at the beginning, Val, about how like just even the term SME is wrong. And I do think it's the very fact that we use the phrase SME, I think, is a reflection of that landscape that you described, Brian, where it's like retail at the bottom, corporate at the top, and everything in between is just a smushy mess that we don't necessarily really want to spend a lot of time or effort thinking about. Yeah, Christoph, what do you think?
I would love to add 2 points. I'd love to add two points for it. So first of all, to your question, we're operating in Germany as well. We see exactly the same problem in Germany. I think that this is a universal problem pretty much across the world, that sort of the banks that have been established for decades or centuries aren't really quite well set up to serve the segment well. The second point that I want to make is Brian and Val made a comment that small businesses can be served through the consumer apps, and that's sort of I think a slight that's sort of like the understanding of the banks, exactly why it doesn't work. So banks have really underinvested, in particularly on the micro end, in understanding businesses better, and that's sort of where we have developed our core strength, because a business that turns over 250K can also have many different directors. It actually has all of the complexity of a business that turns over 10 million, which we're also serving. But the systems that you need to have to be able to understand these businesses, very, very complex, because while they are small, they are as difficult to understand as a somewhat more medium-sized business that typically is actually more stable in its trading patterns than those very small ones. And that's what we've tried the last 10 years to really help those businesses that are most underserved by the banks, and have made a lot of progress, which I hope we can speak a little bit more about over the course of the next half hour or so.
Yeah, no, absolutely. I mean, I was really interested. Obviously, you mentioned your extensive fundraising at the start of the show, but I noticed some of the contributors to that, and particularly kind of the more recent sort of debt funding you guys have done, have been banks themselves. So Citibank, Barclays. I wondered if you could give us some insight into why those organisations are choosing to channel their funding into the likes of iwoca rather than deploying it directly.
Banks are very large utilities, and they have the cheapest cost of capital of anyone in the industry, and are therefore perfectly positioned to provide liquidity to anywhere within sort of the economy. And what they find really difficult is to be able to make lending decisions to the type of SMEs that we're serving, but they have a very cheap cost of capital, and they are able to deploy it through us to these businesses without necessarily taking the credit risk of the businesses that we are funding. And so they're able to provide liquidity to us at a margin that is higher than their cost of funding. So it's very profitable for them to provide us with funding, but they don't need to take credit risk on the SMEs that we are ultimately funding. That's a credit risk that we as a company absorb with our own equity funding. And that, I think, is a great cooperation. We're really utilizing our mutual strengths, the banks with a very low cost of capital, and our ability to understand and score and lend to the businesses that in many cases they would choose not to lend to. And that's why we have established great relationships with a number of banks that are providing funding to us.
Yeah, no, absolutely. Makes sense. And I suppose, Brian, you guys have recently done some research about kind of what the impact might be of some of the regulatory changes that we're likely to see in this space. So obviously risk is such a key part of this whole conversation. And then in the UK, the Prudential Regulation Authority, or the PRA as it's known, is proposing to remove preferential treatment for SMEs known as the SME supporting factor. So yeah, could you maybe kind of explain to listeners a bit more about why this is potentially going to increase the barriers to funding for SMEs, or what the risks might be?
Yeah, no, absolutely. I think it's a really important point that's quite fundamental to the provision of credit to SMEs. So I think what you're referring to is the report that we worked on with Oxera, and we're in association with the Federation of Small Businesses, when the PRA last year published their initial proposal for the new Basel 3.1 capital rules. And for those that aren't aware, these are the rules that effectively govern, among many things, the amount of regulatory capital that banks have to hold against lending exposures. And really that's there to enhance the resilience of banks and to be able to absorb credit losses. So under the current regime, you have this thing called the SME support factor. And what that effectively does, it reduces the regulatory capital that banks have to hold against loan exposures to SMEs by a factor. It's 0.7619 to be specific. And that's true up to a certain amount. And the idea is that actually that is there to facilitate and promote sort of more cost-effective lending to SMEs. As one of the sort of the secondary objectives is to facilitate effective competition in the market. Now, the Basel 3.1 rules that have been proposed by the PRA suggest that this factor will be removed. And the other key thing that they introduced was a 100% floor to the risk weight on property secured business loans. Now, property secured business loans is by far, by value, the greatest sort of asset class of lending to SMEs. Now, in this report, we were looking at estimating the impact of that on lending to SMEs, and working with Oxera, we came to the conclusion that this would result in a 32% increase in capital requirements, the capital that challenger and specialist banks have to hold against SME lending. And all of these, unlike the big banks, are on standardized capital regimes. So they are holding capital that's being dictated directly by the rules, as opposed to the big banks who benefit from internal models, which are called IRB. And the estimate in combination was that this would reduce SME lending overall by up to 44 billion, which is a really considerable amount. The other risk that we highlighted is that this would create a risk to SME lending, that it would become even more expensive, right? So on one hand, you could have a reduction in the provision of credit, and on the other hand, you get a higher interest rates. And this is at a time when many businesses are really worried about rising costs and the cost of their borrowing, which will compromise their ability to scale up and create jobs. And I think it has also been referenced already, but it was interesting at the same time as we were doing this analysis, the BBB published their annual small business finance report and highlighted that in 2022, challenger and specialist banks provided more funding to SMEs than the big banks. And this was like a really big milestone. And actually the more recent data that they've provided has shown that this gap widened further in 2023.
Yeah, absolutely. Well, I think that's set out really clearly for us, like the level of challenge that exists in this space and potentially some of the challenges that are going to increase. So we're going to take a quick pause here for a very quick break. And when we come back, we're going to dig deeper into the alternative lending space, how they're filling the gaps left by big banks, and some of the progress that we are seeing and will continue to see in this space in the coming months and years. So all coming up after a super quick break. Don't go anywhere. The time for community banks and credit unions to win is now. While the big players and exciting new challenges grab headlines, regional institutions are at the heart of the banking ecosystem, putting the service back into financial services. Serving their local communities, these organisations around the world have a unique advantage over their competitors. They have deep, established roots with their customers. They offer a local, personal service, and they're not tangled up in the legacy tech mess that the big banks are. To read, watch, and listen to what else we've got to say about them and how they can win, visit 11fs.com/communitybanks. That's 11fs.com/communitybanks. Welcome back to Fintech Insider Insights, where we've been looking at the downturn in lending appetites from the big banks to SMEs, creating a huge opportunity space for alternative lenders to step up for SMEs and give them the access to capital that they really need. Now we want to look at the changes in the lending space as alternative lenders take over from the big banks in terms of total amounts lent for the first time. Val, change. I mean, I suppose we've got the notes here, change is coming. I suppose change has already arrived in a way. How do we think this disruption is going to continue to evolve? What's coming up next?
So, I mean, look, I think if you look at the SME lending market share, things have definitely moved in the right direction. In 2014, the 5 largest banks in the UK provided about 63% of all SME lending. Today that's about 40%. So, there's been a big shift. And it's definitely kind of moving in the right direction. You're seeing new players kind of coming in and kind of getting that market share. It's interesting because unlike if you look at the retail banking, a lot of the positive change that's happened in the industry has been as a result of features that have created a much better customer experience. And then you've seen larger banks copying those features in an attempt to sort of prevent customers from leaving them. So what I mean by that, I mean like, gambling blockers or, things to fraud prevention, various things like that. And then you've seen some of the larger banks kind of implement similar things so that, customers sort of say, oh, actually, well, now Barclays or Lloyds or whoever offers that. So there's, it's a feature that I really loved from, whichever neobank. I'm going to stick with my main bank as my clearing, one of the clearing banks as my main bank because they offer these features. This is quite different to what you see in the SME space because it's not really about, again, being on an app or kind of the features that you offer. If you look at OakNorth as an example, we're not able to compete with the large banks on price because our cost of funding is so much higher. We pay customers for their deposits. We pay much higher rates for their deposits than the large banks. That's why our cost of funding is much higher. And so as a result, we're much more expensive than if you were to borrow from a Lloyds or indeed one of the big 5 banks, where it's really been a race to the bottom in terms of price. And that's kind of the only way they compete in the SME market. We compete in terms of the experience that we offer. We compete in terms of the understanding of the businesses. And what I mean by that is like, we we all know about the broad challenges that SMEs are facing, right? It's inflation and cost of living crisis, and interest rates have gone up, so borrowing's more expensive. Sure, on a high level, that impacts all businesses. But then you have to start going much more granular. What are the specific things that are going to impact a specific type of business? If you're in, I don't know, the care sector, for example, 1 in 10 care positions are currently not filled. If you're in the hospitality and leisure sector, vacancies are above pre-pandemic levels by 48%, right? So that's labor labor shortages is an area that's particularly challenging for businesses in those spaces. Supply chain issues, the cost of supplies, right? In construction, that's another huge thing, right? The cost of supplies has been incredibly high. And when you have something like a blockage in the Suez Canal and what that means in terms of getting access to certain supplies, those are the kinds of things that a bank partner, a real bank partner, if they understand you and they have that granular understanding of your business, can then support you through. And I think that's something which, we're seeing more of, and that's the sort of positive shift that we will hopefully then start to see, not only neobanks and alternative lenders gaining more market share, but just a much better customer experience for the SME.
Yeah, Christoph, keen to bring you and get your perspective. Like, what is it that you think alternative lenders need to continue to build or continue to do in order to really push for that improvement in customer experience that Val was talking about?
Yeah, let me sort of draw on the last 10 plus years of building the company. I was quite surprised in the sort of first half, or let's say over most of this period. I didn't expect that when I started the company, how important the broker sector has been. And I think, lots of businesses, when they're looking for funding, and in particular the smaller ones that are quite captive by their own banks. So when you're banking with HSBC, you're very unlikely to ever get a loan from Barclays unless you move your entire relationship to Barclays. It's a completely captive relationship. So the broker segment has really been important to be able to tell businesses where to go to get finance. As I said, it's a very diversified landscape. Lots of lenders are specialized in slightly different things, as you can see from that panel. 3 different lenders, 3 different segments we're serving at large. And so brokers were very important as part of the journey of us non-big bank lenders to provide small business loans, in our case, somewhat larger for Val and Brian, to businesses. And continue to be very important in that education of the market. And I think we have thousands of broker relationships that we nurture and love working with them, and have built a lot of technology in order to make it easy for the brokers to provide us with applications from their customers, to keep them abreast on how we're progressing on them, and giving them tools to serve their customers better. So that was a big kind of element of investment on the distribution side. The second bit that we have invested and continue to invest a lot in is our API infrastructure, which is complementing our broker portal. And through our API infrastructure, we're both serving the broker segment for the bigger, larger brokers that have very sophisticated, automated tools that are using our API to send data to us and get real-time decisions back. We're also serving credit marketplaces through those APIs that have that level of automation on their end. But we're also using these APIs for our strategic partners, and they might be the Monzos or the Tides on the one hand, or the eBays on the other hand, that they're completely outside financial services. And I think it's that embedded finance element that will see a lot more traction in the coming 10 years as more and more businesses find it valuable to provide financing in some shape or form to their customer base, and that only works when it's completely seamless, completely automated, and a great experience for their customers. I think that's has been talked a lot about, of course, over the last 5 years and longer. And I think if I look, we started investing in this in 2016, 17, so we have 7-8 years of experience in using that technology to serve businesses across the regions we're operating in. But I think that's kind of where you see the next big level of growth that will become very, very standard for a business to access financing without even approaching a lender directly. Very excited about that.
Yeah, I've always found the role of brokers in this space super fascinating. I worked with, I suppose not one of the big banks, but I suppose a big-ish bank a few years ago that was trying to look at how they might innovate in the sort of SME space. I always feel awful just using that phrase now. And as part of that work, we interviewed brokers, and it was so interesting to kind of play what we heard back, because on one hand, this big-ish bank felt almost like really, really passionately about supporting these brokers. On the other hand, they were almost terrified of them. It was a really sort of complex relationship where brokers seemed to hold loads and loads of power, but yet it was still kind of not quite clear how they fit into that big picture. So I think we probably should talk about brokers a bit more. I don't know, Brian, what's your perspective? Where do brokers fit?
I think they play a really critical part in the in the industry of guiding businesses to the right solution. And I think our industry would not have been able to grow without them. So very, very fond of our brokers, and continue to be so.
Yeah, I mean, we still see, when we look at some of the stats that come out from the likes of the FSB, the Federation of Small Businesses, when they do their indexes and they ask about perceptions of small businesses about the availability of credit, we still see quite negative or very negative data coming out of those studies. So despite kind of the trends that we are seeing about more and more funding coming from alternative lenders, it feels like there is a bit of a delay in that feeding through to what businesses feel in themselves about.
Well, I think that's because although the market share of lending has improved, as in the market share of alternative lenders in the SME lending space has improved, the fact is that, and this is data from Moneyfacts from April, so it's fairly up to date, the big Barclays, HSBC, Lloyds and NatWest, between them now control 85% of UK business accounts and 75% of current accounts. That's, again, not including Santander. So if you include Santander and then call it the big five, the numbers are probably a little bit higher than that. And the fact is that if 85% of businesses are banking with one of those four banks, that's their first port of call most of the time when they're looking for a loan, because logic would dictate, well, I've banked with this bank for how many years or decades, and they know me really well, and therefore it makes way more sense for me to go to them and ask them for a loan versus going to someone who I have no relationship with, who doesn't know me, who potentially will be more expensive because, I don't have a range of other products with them, whatever. And then if your bank says no, guess what? Loads of businesses think, if my bank that I've banked with for years or decades says no, then what chance do I have of getting a loan from somewhere else? And that is part of the problem. So I think there is a constrained demand, right? I think if businesses were aware of the fact that there are alternatives, if they're aware of the full breadth of alternatives available to them, if they were aware of the fact that there are other lenders out there, right? And we can all spend, money on marketing dollars, to try and get the brand out there. But I think, again, it's sort of, you have to overcome that perception of a business that might think, my chances are going to be much higher with my clearing bank versus going to a new provider. So I think that is one of the big challenges. And there was a big effort by the Competition Markets Authority a few years ago where they sort of looked at this, they identified the challenges, and then sort of nothing happened. So I do think there's a lot of work that needs to be done, and it kind of goes back to what we were talking about before in terms of policy and regulation. The fact is, a lot of the regulation out there is very disproportionate. It's sort of like one step forward, two steps back, where it's very difficult for alternative lenders and new banks to compete with the big four or the big five, on a level playing field. And it actually does constrain how much we can lend to SMEs. So I think there's a few things there that a few barriers that prevent SMEs sort of taking a full market view. And it's not like you can just do a price comparison website approach to something like this, because again, the needs of a business in terms of their funding requirements are going to be very complicated. It's not as simple as just saying, I need 5 million, I'm willing to pay this rate for it, because there's going to be obviously different criteria, different levels of risk that a different lender is willing to take.
Yeah, no, absolutely. Well, we're getting towards the end of the show, and I suppose given the role that the three of you play in this space, I'm really keen to kind of make sure I sort of give our listeners a chance to understand like what you're specific kind of focusing on trying to do next. So maybe Christoph, start with you. What's next for iwoca? What are you guys specifically focusing on to take this sector forward? And you said at the beginning you've got the ambition of 1 million small businesses. What's going to get you to that?
Well, we're funding about 10,000 businesses every quarter. So and I still feel there's so much for us to learn about really understanding what are the preferences of our customers in terms of features like the loan terms, repayment features, price, of course, security. So we're investing a lot of our resources into learning more at a much larger scale that we have now. How customers value our value proposition, how we can optimize it to them. That's one big focus. The second, as I alluded to, is embedded finance. We're investing very heavily in making our offering even better for our partners. We have a very full pipeline of more partners that want to dock on to our API and are growing our network and the number of customers we're serving across Germany and the UK. That's a second really big focus. And anyone who is listening to that podcast, please reach out directly to me or the team. We'd be very happy to tell you more about our API and how it's working in practice. And the third is iwoca Pay. I haven't mentioned iwoca Pay yet. It's the purest form of embedded finance. It's where we enable merchants who are selling to small businesses, enable their small business buyers to pay over time rather than upfront, with us being the intermediary in the middle. We're now having more than 400 active merchants using iwoca Pay every month for their customers. We have many thousand transactions that we do through this platform. And I think we're still at the early stages of it. So the growth is very strong. It's really exciting to see how we could embed financing directly in a checkout online as well as through invoices. And I really look forward to see where this will go in the next 5 years.
Yeah, super exciting. Brian, Allica Bank, you guys have had a rapid growth journey to date. What's kind of the key next thing you're focusing on to really help serve SMEs better?
So I think there's been 3 chapters of Allica. So the first was getting the license, which anyone who's been through that process with a bank, it's hard work. The second was then building the products and channels, building that foundation. And then the third, the way that we frame it is when customers, what we're targeting is when customers don't just say, I have a loan with Allica, they say, Allica is my bank. And just to unpack that, and we sort of touched on various bits, actually. Val made very good points about sort of the role of brokers and then actually the hold that the high street banks have when it comes to direct banking, because actually a significant proportion of lending, and one of the biggest challenges for alternative lending is to really crack into the direct side, because naturally businesses do turn to their bank as their first port of call. So that's our really big priority. It's growing our relationships that we have with customers and really banking the full customer, and then being able there to serve not just their lending needs but their deposit and payment needs, and that will help us open up the market. And I think for us the ultimate ambition is to really drive experience and speed in the SME sector in the same way that you've seen in consumer fintech with the likes of Revolut and Starling, and we're a long way off that, but we are on a journey.
Yeah, no, absolutely. And I guess, Val, I suppose people have been watching OakNorth, right, for a while now. You're kind of one of the kind of poster children of fintech. So I guess everyone's very keen to know what's next for OakNorth. You've been quite explicit in your annual report about your ambitions for the US, the kind of the representative office and the M&A stuff you're exploring there. But what do you kind of see as the main priorities for OakNorth to continue positively serving this market?
I mean, I think it's that. So the US expansion, and we've done about $500 million of lending there now. Very small amount, a very small portion of the total amount of lending that we want to do, right? So we have very big ambitions, and we see a big opportunity, as I say, because obviously there are a number of banks that were serving the market that are no longer there, and we do feel there's an opportunity to step up to the plate. And then also the broadening of our offerings. So I mentioned about the additional products, current accounts, savings accounts, credit cards, FX, payments, but really building products that I guess go back to the point around granularity and the specific challenges that businesses face. So it's not just a business current account. It's that if, for example, you're a property business, we know that one of the challenges you have is that every time you do a new project, you tend to set up a special purpose vehicle. And for that, you then need to have a new current account. Now, you'll get treated like a new customer if you try to open an account with a bank, and it can typically take months to get that account open, which is a really pointless delay and an unnecessary delay. So we will say, okay, we know your business. We know this is quite typical for a business like yours. So we'll work to get that account open for you, very, very quickly in a matter of days, so you can get back on, get back to running your business. Doing all the necessary checks and balances, but I think it's sort of trying to look at each of those pain points and then building the proposition around that. So that's how we hope to compete in the market in terms of our broader offering, and that's something that we're continuing to build out. And if any business is interested who's listening, you can check it out, oaknorth.co.uk/business-banking, and you can sign up to our wait list and join the beta there. But those are kind of, I think, a couple of the really the priority areas for us in terms of our growth going forward.
Really, really interesting. Well, that sadly wraps up today's discussion. I had so many other things I wanted to ask all of you, but we've run out of time. Thank you so much for joining me, for sharing your perspective for our listeners. Where can people find out more about your value? You've given us some steers already, but if people want to find out more about OakNorth more generally, or you particularly, where should they look?
So yeah, oaknorth.co.uk or on LinkedIn. And if you want to connect with me personally, then Valentina Kristensen on LinkedIn.
Awesome. Christoph, what about you?
Well, you can find more about us on iwoca.co.uk. You can also send me an email on c@iwoca.co.uk. I'm happy to hear from you.
Awesome. And Brian, what about you?
For Allica, you can find lots of information about Allica at our website, which is www.allica.bank. You can reach out to me on LinkedIn. I think if you're a business owner and you're listening and you want to experience better business banking, just get in touch, and you'll get to speak to a real person who'll take the time to get to know your business.
Sounds good. And as for me, you can find me on LinkedIn as well, Kate Moody, or kate@learnfirst.com. Thank you so much for listening. If you like what you've heard, please follow our podcast. Don't forget to leave us a review. It helps us to make it better and helps others to find this show. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider, or email podcasts@11fs.com. Thanks very much and goodbye.
Keeping up with all the noise and news from the world of financial services isn't easy. It's easy to get lost in buzzwords, jargon, and industry speak. So sometimes you just need a quick human rundown of the biggest stories. Well, you are in luck. Bite-Sized is our very own weekly newsletter that takes the biggest news stories from financial services and tells you exactly what's happening, why it matters, and what comes next. Bite-Sized goes out every Friday at 11 a.m, so you can enjoy it with a coffee as you wrap up your week. Stay up to speed with the fast-moving world of financial services and subscribe today at 11fs.com/newsletters. That's 11fs.com/newsletters.